Hi, I'm John McCaffrey. I'm a tax partner at Alexander & Co, and today I'm going to talk about education trusts for minors. An issue many parents have, particularly with private education, is the fact that they have to pay it out of gross income. So if you're a 45% taxpayer to get a £10,000 fee into your private school, it's going to cost you almost £19,000. If you're a 40% taxpayer, it's looking at just over £17,000. However, if the child was able to earn their own income, they would have a personal allowance available to them. And the first £11,850 of their income would be tax-free. And that represents a significant saving against the amounts the parents have to pay. The problem is that if parents try to divert income towards their children, it's assessed back on the parents straight away. However, that rule doesn't apply to anybody else. So if you've got grandparents or aunts or uncles or even very generous friends, they may be able to set up an arrangement whereby income is passed to these children for their maintenance and education, and significant tax savings can be made. There's also a significant inheritance tax benefit to the person who is setting up the structure. So the way it works is that the individuals involved set up a trust. And into that trust, they would pass either cash or assets, or if they're a company owner, they could pass some of the shares in the company to the trust. There are a number of tax considerations that you need to look at that point. Certain assets will have capital gains attached, but these can be rolled into the trust and may not be payable when it's done. Other assets attract lifetime inheritance tax charges, but you can gift up to £650,000 worth of asset during your lifetime without an inheritance tax charge arising, and that allowance refreshes every 7 years or so. If you pass your own company shares in and providing it's a trading company, certain relief called business property relief applies, and there should be no inheritance tax charge. So there are many options for getting these assets into the trust without tax charges arising. Once the asset's in the trust, they are invested, managed, looked after, and hopefully they generate sufficient income to be able to pay a £10,000 fee out to the minors or the beneficiaries of the trust. The way it works from a tax point of view is that the income is passed to the beneficiary and is taxed on that beneficiary. As I mentioned before, that beneficiary is likely to have a personal allowance available. So they can get £10,000 worth of income, all covered by their personal allowance, and that will represent a significant saving against what the parents would have to pay out. There are other uses to the trust, so similar arrangements can be made for universities or university fees. It can also be used for paying house deposits for children as they get older. It's a flexible arrangement. The additional benefit is that the trustees control the assets. So the beneficiaries, the minors, the people at university never get their hands on the capital, and so there's an element of control there. In conclusion then, if the circumstances are right, there are significant tax savings that can be made by both parents of minors and the wider family in terms of setting up this structure.